Hi everyone, welcome to Investing Club. In this video, I'm going to go over Cathie Wood's portfolio from ARK Invest. The ticker for this ETF is ARKK, and Cathie Wood is becoming more and more popular as a fund manager who invests in these up-and-coming innovation companies. And there has been a lot of popularity around some of the companies she is investing in. So in this video, I'm going to go through her 10 largest holdings and talk about my thoughts on them. And right off the bat, I know I'm not going to like a lot of the companies she's investing in. Why? Because I am a value investor, and the companies that Cathie Wood is investing in are the companies of the future, right? Not today. So what does that mean? Well, these companies are likely to be losing a lot of money and are likely to have a lot of debt. Two things that I don't like when analyzing a company. So I do know that I'm not going to find a lot of these companies attractive right off the bat. But what I will do in this video is go through her top 10 holdings and take a look at their profitability and their financial health, and then decide if I like the stock or not. So here are Cathie Wood's top 10 holdings. I will put a picture up on the screen right now, and I will go in order. So the first one is Tesla, and Tesla is around 10% of her portfolio. And so here is Tesla. The website I'm on right now is Finviz. It will be the first link down in the description. And I use this website a lot because it really gives the big picture on a company all in one spot, where you get a ton of this financial information. So I would definitely check out that website if you haven't already. So now let's take a look at the numbers of Tesla. So if you're watching this video, you most likely know what Tesla is. They make electric cars, and Elon Musk is the CEO. And there's a few things that jump out to me when I look at Tesla. They have yet to have a full year of profitability. In the last 12 months, they've lost 87 cents a share, but they are expected to become profitable this year. For next year, their earnings are expected to be $11.62 a share. So analysts are expecting a big jump to profitability for Tesla next year. I don't necessarily see that happening. I'd rather take a wait and see approach to see if they actually become profitable before I would invest in Tesla. But their sales have been growing at 50% a year, extremely fast. Even though their price to free cash flow ratio is high, they have generated some free cash flow, which is very encouraging if you are a shareholder of Tesla. Now, their gross margin is 18%. That's actually not bad. And their operating margin is under 3%, which is to be expected. They are a car company. They make cars. They are in a very capital intensive industry. And so with that, you're not usually going to see these huge margins. Their forward PE ratio is 71. I think the big thing here is even if they make $11.62 in earnings per share next year, you are paying 71 years in advance for their earnings. So you have to understand, if you're paying for Tesla at this price, you are pricing in extreme growth over the next decade, which could happen very well. But it is definitely something to think about when you are paying a forward PE of 71, even for a company that's been growing as fast as Tesla is, that is an extremely high valuation. Now, in terms of their financial situation, their debt to equity is a 1.5. It's not the worst. Obviously, they have a lot of debt. They're a car company, so you need to take on a lot of debt to be able to build out the infrastructure that a company like Tesla needs. But I don't think they would have a problem raising more money if they needed to. Their current ratio is a 1.2, so that does concern me a little bit. If we see a period right now where their sales drop off a little bit, then this could put them in a tough situation in the short term financially. But again, I think they would be able to raise money. So what do I think about Tesla? Well, at $835, for me, Tesla is definitely not a buy. To buy Tesla right now, you would have to have extreme faith in the company and Elon Musk that they would be able to grow the company extremely fast over the next decade to justify this high valuation. And so I would probably never invest in Tesla anyway. If I was going to start buying into Tesla, I would definitely wait for a lower price. So this stock gets the thumbs down for me at the current price. So Tesla gets a thumbs down from me just because of the current price it is trading at. The next stock is Square. Square is 7.5% of her portfolio. Square is the payment service that I'm sure a lot of you have used. It has become very popular in the last few years, and Square is definitely an interesting pick. They are profitable, which is something I definitely like to see in a company like this. It's really important to me to have some proof that you can become profitable. And over the next 5 years, Square's earnings are expected to grow at 31% a year. So this is still an extremely fast grower. Their ROI and ROE are both very high, which is a very encouraging sign, and their gross margins are huge at almost 40%. For the financial health of Square, their long-term debt to equity is a 0.97, so they do have some long-term debt, but in the short term, they have their debt to equity is a 0. So this company has no debt for the next few years, and their current ratio is a 2.2. So this company is well prepared financially to handle any sort of downturn in the economy where they wouldn't be making as much money. Now, that being said, this company is extremely overvalued right now, in my opinion. Their PE is 175, which to me, it doesn't matter what company it is. I would never pay that valuation for a company. Their forward PE is a little lower at 87, but again, way too high. And so taking a look right now, they're currently trading at $80, which is around their all-time high. So I would not pay this price for Square. However, if we saw this company revisit the lows that it had in March at under $40, that is where it gets intriguing to me. This is a company that I actually would buy because they have already become profitable and they have a clear sustainable competitive advantage that they will be able to continue growing at a high rate for a number of years. So this is a company that I am interested in, but the price is simply way too high right now, and I would not consider buying unless it was under $40. And so for me, this stock gets a thumbs up, but not at this price. So this is a stock I would buy, but the price is too high right now. The third stock is Invitae Corp, ticker NVTA, and this company is in the industry of genetics and DNA. So definitely a very innovative company in an industry that looks very promising for the future. Now, this company has been losing a ton of money. In the last 12 months, they've lost $3.14 per share, and next year that's expected to drop a little bit, but it's still very negative. So this company is nowhere close to making a profit, in my opinion. Over the next 5 years, their earnings are expected to grow at 8%. So at this rate, they're not going to become profitable in the next 5 years. This company did generate $240 million in sales last year. So their price to sales is an 8.91. So I would definitely compare this to other companies in the space to see if that is a fair valuation or not for this company. In terms of their financial health, they have a good current ratio. So in the short term, they are fine. However, they do have a lot of debt in the medium and long term. And so this is something I would be concerned about if this company can't break a profit, because they're going to need money to pay off that debt at some point. And if they can't become profitable in the next 5 years, that would be a little concerning for me. And another thing I want to point to is all of the insider trading going on this company. And it is not a pretty picture. Since July 13th of last year, all of the insider trading has been insider selling. And this has been happening consistently for the last year or so. And so this is definitely not something I like to see. There's usually, if there's a few insider sells here and there, it's not a big deal. But when you see such consistent selling like this and no insider buying over the past year, that is definitely not an encouraging sign. So just based on these things, this company definitely gets a thumbs down from me. I would not invest in this company. There's really no price that would make this an attractive investment to me. Now, the next stock on Cathie Wood's portfolio is Crispr Therapeutics, ticker CRSP. And Crispr is a gene editing company that uses the Crispr technology in an attempt to edit DNA. So again, this is a super cool company in a very innovative industry that has a bright future. So taking a look at this company, in the past 12 months, they were profitable. However, next year they're expected to lose $5.20. So this is a company that's not yet consistently profitable, and they have no earnings growth estimate. So the odds are that this company will not become consistently profitable for quite a while. Their price to sales is also at a 13, which makes this company very highly valued. Now, this company is in a excellent spot financially. Their current ratio is a 16, and they have absolutely no debt. So this company is loaded up on cash and short-term assets, and they have no debt. So that is the great thing about this company, that they don't have to be profitable, and they really have no fears of running out of money. This company is clearly in a great financial position that will allow them to focus on investing in their company to be able to become profitable eventually. Now, that being said, would I buy at these prices? Absolutely not. I think this company is way overvalued right now. And not too long ago in March, it was at under $35 a share. So I'll give this one the little shrug emoji. Could be interesting if it got down to a low enough price, but right now, definitely I would not consider buying this stock. All right, the next stock in Cathie Wood's portfolio is TWOU Inc., ticker TWOU, and this one sits at around 5% of her portfolio. And this stock is an education technology company that operates all over the world. And so what do I think? This company lost a ton of money in the past 12 months. They've lost $4.34 per share, and next year that is expected to drop a lot. And their earnings are expected to grow at 25% over the next 5 years. So this company looks like it has a good chance at becoming profitable in the next 5 years. They have a current ratio of 1.4, and their debt is 0.37, which is all long-term debt. So not too concerned about the debt. In the short term, again, if we see some sort of slowdown in the global economy, then this stock could be in a little trouble in the short term, but overall it looks like the management of this company has been very efficient in taking on a very manageable amount of debt for this company. Now in March, this company was almost at $10, and right now it's at over $36. So I would not buy this company at these prices. However, if it did get down to under $15, this is definitely a one I would take a look at. So this one is a thumbs up, but not at this price. The next stock is Illumina, ticker ILMN, and this one makes up around 5% of the portfolio. And this company is involved in genetic and genomic analysis. Now, this is probably the best company I've seen on this list so far. They are very profitable and expected to keep growing their earnings at 10%. So this is a profitable company, which I like. Their margins are huge. Gross margin 70%, operating margin and profit margin both in the 20%. So this is a company that makes huge margins on the products they sell. In terms of financial health, this company is in an excellent position. Their current ratio is over a 4, and their debt to equity is a 0.25. So this company is in a very good position financially, and they are profitable and expected to keep growing those earnings. Now, that being said, this company is overvalued right now. Their PE is a 57 and forward PE is a 47. So I would not be paying these high prices for a company like this. This company, since March, this company has ran up huge. It's almost doubled. And so I would definitely not be paying over $300 for this company. If it did drop to the $200 level, then I would definitely take a closer look, because there I think things start to get attractive with this company. So I'll give this one a thumbs up, but not at this price. I would have to wait for a lower drop to around $200 to begin buying this company. Seventh stock on this list is Proto Labs, ticker PRLB, and Proto Labs is a 3D printing company. Again, another innovative industry that is expected to grow a lot in the coming years. So this company is profitable, which I definitely like to see, and their earnings per share are expected to grow at 25%. So this is a very fast grower. They have good returns on investment and returns on equity, both in the double digits. So this looks like a company that is very well managed. Their gross margin is 50%, and they have decent operating and profit margins, and their current ratio is a 4.5, and they have no debt. So this company is obviously very well managed. They have no debt, and they are making good returns on investment and on equity, and they are making very large margins and are still expected to grow at 25% a year. So this is definitely an intriguing company to me. Now, that being said, they are most likely overvalued right now. The PE is a 54, and so I would not pay a 54 PE for this company. Back in March, they were at around $60 a share, and again, at that price is where things start to get more interesting for me. So that is where I would start taking a closer look at this company. I'll give this stock a thumbs up, but not at these prices. The next stock is Zillow, ticker symbol Z. This one makes up around 4.6% of the portfolio, and Zillow, of course, is the real estate company. Now, Zillow is not profitable and doesn't have a PE ratio. They're making no free cash flow. Now, taking a look at Yahoo Finance, this company does have a larger amount of current assets compared to the current liability. So they are in a pretty good financial position. And in all honesty, I don't know when Zillow will become profitable and if they will become profitable. So for that reason, this company gets a thumbs down from me. I would probably not invest in Zillow regardless of what the price is. Now, the next stock on this portfolio is Roku, ticker ROKU. And this company is in the TV and streaming industry. So this company isn't profitable yet. They're burning a bunch of cash, and their current ratio is a 2.6. So they're in a good financial position. They have a pretty conservative amount of debt, and this company is just plain overvalued right now. Roku is probably one I would never invest in, just because I don't really believe in their company, and I really don't believe they'll be the dominant player in streaming for the long term. So for this reason, Roku gets a thumbs down. I would not be investing in Roku. And the last stock, making up only 3.73% of the portfolio, is Stratasys, ticker SSYS. And Stratasys is a computer hardware company. So first off, they lost money in the past 12 months, but they are expected to be profitable next year. So that is an encouraging sign. And their earnings are expected to grow at 20% a year. So this is a very fast grower, expected to become profitable in the next year. Now, again, that being said, when I see companies like this, I would always rather take a wait and see approach and wait for them to become profitable, because a lot of the times the analyst estimates are wrong for these unprofitable companies where their earnings are harder to predict. Now, that being said, they are in an excellent financial position. Current ratios of 3.9, and they have no debt. So again, with this company, pretty much just a waiting game. They have no concern of running out of money or being in any financial troubles. The thing for me is just waiting to see them become profitable before I would consider investing in them. In the forward PE is 140, so even if they make 13 cents a share next year, still extremely overvalued. So I'm going to have to give this company a thumbs down, because even if they become profitable, this stock price would have to tank for me to even consider investing in the company. At this valuation, it is simply way too expensive for me, and it probably won't ever get down to a price where I would be comfortable investing. So for that reason, this one gets a thumbs down. And that is it for the 10 stocks in ARK Invest portfolio. The ticker for this ETF is ARKK. And overall, I am actually pretty surprised. There were some pretty good companies in here. Again, a lot of them are not profitable and probably won't be for a while. And that's what I expected. But there are a couple good picks in here that are profitable and could turn out to provide an excellent return over the long term. So that's it for this video. Let me know what you think about these stocks. If you own any of them, if you would invest in this ETF, comment down below, and I will see you on the next video.